So I'm going to quickly go through some of the factors in commercial real estate loan underwriting. I have some more detailed videos also posted, so I'm going to try to make this a little quick and just kind of recap the important factors and briefly describe what they are. Most obviously, the type of property it is and its location, not just what metro it's in, but within a particular city, what neighborhood it's in. Um, that's obviously going to be a factor that a lender is going to consider. The number and depth of the lending market for, let's say, multifamily residential, meaning apartment buildings. There's probably many more lenders for that than for, let's say, industrial property or very special use kind of property, or even retail, like a strip mall. It's going to be harder to find a lender uh, for that kind of property versus just buying an apartment building somewhere, kind of in a central city location. So the property type is going to matter, and its location is also going to be a factor. Uh, you as the borrower, your financial strength, meaning if you're taking out $1 million loan, especially if it's a recourse debt, meaning you have to give a personal guarantee. So I talked about that in the previous video. If it's a recourse uh, type of loan, your financial strength as an individual is going to be very important because if a bank is going to ask you to give a personal guarantee on a $3 million loan, they're going to verify that your net worth is at least $3 million. Okay, or they're gonna make sure that you have a substantial net worth, or else your guarantee is kind of meaningless, because if you don't have the financial capacity to kind of back up the loan you're guaranteeing, then there's no point. The value of the guarantee is kind of like not that useful if you don't have much in terms of assets and other things to kind of back up the loan if things went bad. Um, a lot of lenders also will heavily scrutinize your experience in managing and investing in the particular type of property that you're trying to get the loan for. And so they want to see that you have kind of had experience managing that kind of property, executing the business plan that you're proposing. And so they're going to look to your experience. And if you don't have the experience, you'll likely have to find someone to partner with that does have experience, because the lender is not going to just give a large loan for, like, a kind of complicated property to manage operationally to someone that doesn't have experience. So you'll have to create a team that is going to bring that if you yourself don't. Okay, loan to value. I'm going to do a separate video kind of showing this calculation, but essentially it's uh, the amount of the loan as compared to the purchase price or the value of the property. Okay, so um, if you have a $2 million property, let's say you're buying the property for 2 million, and you're getting a mortgage for 1.5 million, then the loan to value is going to be the loan, so 1.5 divided by 2, which equals 0.75, which is the same as 75%. So this is a 75% loan to value. Now, probably the more realistic way to look at it is take the amount that you're going to need for the purchase, so 2 million, and maybe the bank is going to say the max we're going to do is 65% LTV. So then you multiply this by 0.65, which equals 1.3 million. So this is how much you're going to be able to get from the bank. And of course, you'll have to come up with the difference, the 700K, right? Because 1.3 plus 700K is going to get you your $2 million purchase price. So typically, a loan is going to kind of have a maximum loan to value. And of course, the value is not necessarily this 2 million. That's just the price that you're willing to pay. So the bank is going to have an appraisal done for the property to verify how much it's actually worth, and they're only going to give 65% of that appraised value. Um, you're you're hoping that the appraisal is going to come back somewhere close to $2 million. Um, And if it doesn't, if it, let's say the appraisal came back and it said it's only worth 1.5 million, then you might also start scratching your head and ask yourself, am I paying too much for this property, right? So what you're paying in the appraisal should correlate pretty well. And if they don't, then there's something significantly kind of off with the deal that you're doing potentially. The DSCR is the debt service coverage ratio. Basically, in very simple terms, and again, I'm going to show you some real numbers. We'll do an example for a real deal and calculate this. But let's say your monthly mortgage payment is $10,000 per month. And let's say your NOI, your net operating income, meaning how much kind of income your property is generating after you pay expenses. So this is like the rent minus your insurance, utilities, maintenance per month. If you're making, let's say, 13,000 per month, this is your mortgage payment, and this is your NOI. So the first obvious thing is that it's good. The bank is going to be like, they're happy that your NOI is greater than the mortgage payment. Because if it wasn't, then you wouldn't have enough income to support the mortgage payment. So the fact that it, 10K, 13K is greater than 10K, that's the first uh, kind of happy thing that the bank is going to be. So but they're going to want a margin of safety because if you're only making 10K per month in NOI and your mortgage payment was 10K, there's nothing left over. There's no buffer. Okay, so the DSCR is kind of asking for a buffer. So if you had a 1.2, let's say this is 1.2 is your minimum DSCR. So let's check to see. So what is this? This is debt service coverage ratio. So your debt service is 10K. And so you want to see how well covered it is with the income. So what it is simply 13K divided by 10K, which equals 1.3. Okay. So the coverage ratio for this particular deal is above this minimum. So 1.3 is greater than 1.2. And the higher this ratio, the better. Let's make this 20K. Let's say you were generating instead of 13K per month in NOI, 20K. So this goes to 2. Okay? So the higher this number is, the more income there is to support the mortgage payment, the more margin of safety there is. So the higher the DSCR, the better. And in order to calculate the DSCR, you're going to have some idea of the profit and loss. So the profit and loss statement, they're going to look at the actuals, so what the property has actually been generating. And we talked about this terminology, T12. So they'll see what's been happening in the last 12 months. And then, especially for deals that you're planning on doing a lot of rehab, meaning you're going to fix up the units and rent them out for a higher rents than they currently are, the pro forma profit and loss statement is also going to be important. Those financial statements, which are going to list basically how much you've collected in rent, what the expenses to operate the property are. You're going to have a financial statement that's going to show that information, and you're going to come basically to an NOI, and you'll know what the T12 NOI is because it's based on what's actually taken place, how much rent you've collected. If it's an apartment building, maybe there's a laundry room, so you're collecting some income there. So you're gonna have all the income, you can have all the expenses that actually were incurred, and you're going to have the actual NOI. And with that, you'll be able to calculate what the DSCR is going to be, uh, assuming a certain loan, the amount of the loan, the interest rate of the loan. You're going to have that. You're going to calculate the monthly payment, and you're going to see how the NOI compares to that hypothetical monthly mortgage payment and see what the DSCR is. Okay, so uh, the DSCR calculation is going to be informed by the NOI, which is going to come from these financial statements. Okay, so the lender is also going to care about in-place lease and tenant quality. So, for example, if you have like a strip mall, okay, like a little strip retail center, like when you're driving on the road, you'll see like 3 or 4 little shops in a little mini shopping center. Uh, it's gonna matter to the lender whether one of those spaces, like let's say you have one space occupied by Starbucks, one space occupied by a Subway, and one space occupied by some other like large corporate tenant, okay? Uh, that's gonna look much safer because Starbucks is a national company. They're gonna pay their rent. They're gonna maintain that property well. It's a much less risky tenant than just like a mom and pop coffee shop. Okay, that's there. So who the tenant is and how creditworthy they are is also going to matter to the lender because if your tenants are not paying the rent, then you are not going to be able to pay the mortgage. So the lender is going to care about who your tenants are. Um, and so there's going to be some kind of investigation by the lender into those specifics. Even if you had Starbucks in place, right, and you're like a little retail shopping center, uh, if there's only 1 or 2 years left on the lease, the lender is going to be concerned by that because if Starbucks leaves after those 1 or 2 years, then you may have to find a new tenant, and that might be difficult, and that's going to really impact the income that's been generated in the prior years. In the prior years, Starbucks has been there. Maybe they signed a 10-year lease initially, and if there's only 1 or 2 years left, you can't really count on the same financials as the last 8 years because Starbucks was in there and paying the rent. And that may not be true going forward if it's kind of near the end of the lease term. Any environmental issues? So um, some properties have environmental contamination or some issue with uh, you know some kind of risk from an environmental perspective. So if you're, for example, buying a gas station, maybe those underground storage tanks have been leaking, and that's a big mess because that's going to involve government. That's going to involve lawsuits potentially if that leak has kind of gotten into groundwater. So the lender is going to oftentimes require you to do an environmental kind of assessment to make sure there's no issues like that going on, because they want to mitigate that risk because that can basically bankrupt a property owner if there's some environmental contamination because it's very expensive and uh, takes a lot of time to clean up, time and effort. So an environmental issue could spell disaster for a commercial property. And then economic conditions. So the lender is also just going to if you're trying to open up a restaurant and there's like a big recession, then a lender may not like that. Even for the lender themselves, if they're experiencing kind of turmoil because they have all these loans outstanding, if a lot of the loans are going bad, they're not in a position to kind of give out new loans. So they're going to only give out loans that are like very high quality. So the economic conditions are going to be a factor in their kind of underwriting decision of whether to give you a loan or not.